Okay, good morning, everyone. First of all, I want to thank Craig for inviting me to be here. Okay, have the opportunity to speak with everyone today. Actually, I was here 2 years ago. I was so inspired by the talk, by discussions, by the research. That's why I said I should do more research for practical purposes. Then work on it. Now here, 2 years after, I'm here. So I'm very happy to be here again this time to talk with you, to share our research with you, okay? So this research actually is with co-authors, and the names are here. So they will get all the credits too. In case there's any mistakes, they will get the mistakes, okay? Go ask them for mistakes, okay? Now, this is the paper about pricing kernel. Somebody asked me, say, what's the pricing kernel? Kind of the buzzwords. Well, pricing kernel, it's a little bit academic. Basically, it tells you that, okay, what's the discount factor? You are willing to pay an asset for a price of $100. Actually, the potential payoff will be $150. How do you transfer 150 to 100? That's your discount factor. So pricing kernel is the same as discount factor, okay? Somebody say, I'm still kind of puzzling to me. Okay, then let's go the other way, linear regression. Everybody knows linear regression. So the pricing kernel essentially is that, okay, you got a bunch of factors that will price all the assets with almost zero alpha. If you find those factors, you find the pricing kernel, you find all the factors that are useful, relevant to the stock market. So that's what it is. Okay, so this way, probably easier for you to understand what the pricing kernel is. Okay, so pricing kernel essentially is equivalent to finding all the factors that are going to price all the assets in the stock market. Okay, here we focus on the stock market. So that's the pricing kernel. Okay. Now, let's give you some perspective, give you a brief history of pricing kernel. Okay, pricing kernel, like every invention in the world, we have from 0 to 1, first stage. Probably take don't know how many years, maybe, okay, wherever you have asset pricing, then go to the stage, you get 1. Then we have from 1 to 3, not 1 to 2, from 1 to 3. That took about 30 years. Then we have from 3 to potential infinity. That takes almost no time. So I will briefly cap to you about this model. First, we have the one-factor model. Just to wake up some of you in the audience who is be sure you're awake. Do you know what's the first factor in the equity market? Anyone? Beta. Beta? Market, exactly. First factor is market, cap M. So cap M was kind of invented by human being, okay, human intelligence, like Jacobs says, okay, that in the 1960s, okay. Everybody created cap M to sharp. Actually, there are authors simultaneously, smart people, almost even found the same thing at almost the same time. Okay, the people probably can attribute the cap M to, they provide us the first most important factor that help us to price all the assets. Okay. This we got our step in finance from 0 to 1 asset pricing. So this, because 0 to 1 is a big jump. This, of course, when overpriced. Probably hope a lot of you agree. They are Wall Street experts. A lot of you here. Maybe now cap M becomes a simple word, rather than something mysterious. Okay, in the real world. Okay, not simple. Of course, we have questions. Back then, people want to ask how good this model is, right? So in the early years, actually in the 1970s, people have done some testing. Like the Black have some tests. Then pharma has some tests with co-authors that, okay, we also invented the famous farm back-based approach at the same time. So the early tests. Okay. In the 80s, actually started people talk about multivariate testing. Okay, then stuck with Michael Gibbons. There's a Wharton professor. All right. Then at the same time, Robert Stambaugh, and the discussion of this paper, amazing. Who discussed my paper, I'm very happy to. He's one of the pioneers too in testing. Then there's some other people working on this at the same time. Many testing. Okay. Actually, for example, Craig has a paper on the testing. Actually, Chris also has one. I somehow could not dig it out because the time is limited. Okay, then you have the papers like about Stambaugh 2, try to examine all these factor models. How does it work? I have my paper with my advisor, Professor Cam Harvey, from whom I learned a lot about finance. Then we did some testing too. Actually, at that time, we already found that the probability for the CAPM to be true is very, very, very small. So that's the conclusion of that paper. Okay? So essentially, what the test tell us? In the older days, early tests tell us, okay, CAPM is not too bad. But that time, people kind of in favor of CAPM in the older days. Then people say, oh, not so good. Okay, we should do something new. Okay, and this time, actually, people also look at APT, including, I forgot to review here, including like here, like Rob Krajcik. He has his pioneering work in APT, which is kind of multi-factor model. So essentially here, we're questioning that now we should break number one, break the barrier of one, we should go beyond one factor. So that's really people, okay, has come up to the consensus. Then finally, 30 years after CAPM, we have the three-factor model. I guess some of you, a lot of you know here, which three factors am I talking about? Exactly. So it's famous, the famous from the three-factor models, including market is very important, okay, but then their size, their value, that can matter. So that's the famous, okay, from 1 to 3 step in finance, okay, which also won Nobel Prize. Now, of course, you have a question how good it is. Then suddenly people have this idea of coming with more factors. Once this is 3, after from 3, you can generate from 4, 5, 6, keep going on. They got factors, low volatility factor, quantitative factor, blah, 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 keep going. Then you got the so-called factor rule. Now came into birth very quickly in a short period of time. That's what the factor rule referred to earlier, okay, by Mr. Levy. Okay? Then now we got so many factors. Actually, hundreds of factors there. Also, you can potentially, theoretically simulate billions of factors based upon them. Okay? Or get 20 portfolios, get some model simulations, etc. Then what's the next question? The question that actually will be asked, how many factors do we really need? That really we should be taking more seriously or should we care about? So that's really this paper was trying to do, is trying to find out. Given so many factors, right? How many of them are really essential to us or to your investment decision making? Okay? So that's the way, the problem we try to address. So what do we do here? In this paper, we're going to do the following, okay? We're saying that now we have so many factors, hundreds of them. People can apply them to do forecasting, form long-short portfolio. You can use them to find profitable opportunities for mergers, acquisitions, whatever. Okay? And here we focus the following. We say, okay, how about the pricing kernel? Because theoretically, the pricing kernel is what matters to price all the assets. Okay, this seems something people haven't done it yet. Okay, we think this really is kind of opening interesting area from theoretical point of view, also from practical point of view. You're a fund manager, you're max up the portfolio. What do you care? You want to care your optimal portfolio. Okay, given the risk, you want to get the best return for your portfolio as optimal portfolio. So the pricing kernel is mathematically, quantitatively the same as the pricing kernel equivalent. Okay, so I think this is an object of common interest, both theory and both practice. So that's why I think this paper seems to fit pretty well for this conference. Okay. Now, so I want to find this optimal portfolio. How to do that? Then you have hundreds of assets. We'll just write down the return in the usual way. Put on the return, expected return, the covariance risk as usual, as if there were only 5, write down the equation. So what we want to solve, suppose you have a utility, is mean variance utility your hit risk, your maximum return, you solve in a standard way your Levy portfolio weights. The problem here is that there are so many assets. If you plug in the sample estimates to this portfolio, you will not be able to estimate it because we simply do not have enough data for estimating the covariance matrix, for estimating the mean accurately. So that's the problem. So we got to simplify from the big data problem, simplify to something tractable, doable. So that's the issue here. So mathematically also we can derive the formula, but in the real world, in implementation, we have a problem here. So that's really try to resolve, okay? Now, how do we resolve that problem? Let's try to find link the original problem to a problem which is slightly different, which is linear regression. Actually, it's interesting that, one can show as here that if you do linear regression of 1 over gamma, and all this stock return, all the asset return, all the factors you want to invest in, just do a linear regression. Hypothetically, suppose you can do this linear regression with billions of factors. Suppose you can do that. Then the coefficients, amazingly, will be exactly the portfolio weights you want. Don't need to look for anywhere else. That linear regression will provide you the portfolio weights, your allocation to those factors right there. So just solve this linear regression problem. Okay. Actually, this link between our portfolio and the linear regression is not a new discovery, which was there years ago. Okay, actually, as referred back in the 1980s. Just at that time, people just have no use for it. But today, when you have hundreds of factors, you want to invest in to exploit all the opportunities, then that linear regression become relevant, and you can design some ways to make the linear regression feasible in spite of big data, in spite of hundreds of factors. So that's really the main idea, the main motivation to do, okay? Okay, now on to the next step. How to do the linear regression? Come back here, then we know that in the traditional way, you cannot do it, right? That will explode because the covariance matrix will explode. Then easy with modern machine learning or associated with AI, or AI really is a use of all these methods. What's AI? AI just prediction. Like large language models, you want to predict what's the next word, what the next phrase will be. From that, it get all these laws of language, the laws of what we do everything. So everything really is about prediction. The linear regression, which is essentially also a prediction problem, you want to minimize the pricing error. There are so many assets, then just try to chart them off that impose restriction, so-called LASSO restriction, which allows you to minimize the pricing error or minimize the portfolio tracking error, whatever. At the same time, try to squeeze the factor space. Try to make the factor space, try to make the choice space as small as possible. That's kind of lambda. So penalize. On the one hand, like in the real world, you want to maximize your portfolio, maximize the Sharpe ratio. Okay, we have many assets to choose from. On the other hand, you don't want to choose too many of them. So you want to reduce the size as small as possible, at the same time to maximize your Sharpe ratio. So that's really what it does. That's the goal. So wonderfully, that today we have easy tools to solve this problem, just a piece of cake today. Okay, with all the machine learning, just a standard Python code you apply, you can solve it. Okay, yeah. Actually, even without today's tool, back in 1993, actually my co-author wrote the program to solve this by ourselves. We got a paper back in 1993, probably in Journal of Finance, to do this. Okay. Anyway, it's very easy to do. Feasible to do today for all of you, even without knowing much about any of these equations. It's just applying Python code. Plug in, then you solve it. Or you ask ChatGPT. ChatGPT will suggest you what's the Python code to solve this problem. Okay. Yeah. That's really today life become much easier. Very convenient. Anyway, so this problem, mathematically really is in the real world really doable problem. Okay. Now theoretically, you can show that indeed everything will converge or works well. I just want to skip that. Put them equation here for those of you who like equations. Okay. Some people who don't say equations, like they eat a meal without meat, they feel nothing. Here, I'll give you some equations to feel there's some bones in this talk. Okay. Then you can prove mathematically if it works. Okay. Now let's go to data. Then how actually what the empirical results are. What can we really do in the real world? Okay. Now the data are standard. Only difference is that we apply this strategy to 100 anomalies. The reason why is that because anomalies represents more investment opportunities. By design, they're trying to mutually exclusive. They're trying to be different. If you apply them to stocks, other stocks are highly correlated. Then you have to do some additional tricks. Here we just apply it to the standard anomalies. The easiest way to look for pricing kernel is through anomalies. Okay, then there are 174 of them, for which we have all the data available for many years before to current. Okay, we apply. What's the result? Bottom line. Result is that you get from this our approach very easy to apply by all of you. You get a Sharpe ratio of 3.5. Really amazing. Now quant manager really, it's a huge number. If buy and hold the stock market, we get a Sharpe ratio of about 0.5. This we're talking about is about 7 times over. Really potentially huge. Okay. Amazing opportunity. If you really apply to the large of universe of factors, that's what you could get. Also, methodology-wise, if you compare our method with some other methods, available methods, you can also modify those methods, can do it too. Of course, you will underperform. We're not saying the method we advertise is the first one. No, all the methods they can still apply, but they give you this. Give you not so good results, but still okay. They can easily get a Sharpe ratio around 3. Okay, so essentially it's telling you that there's a huge opportunity in big data. Also, you compare this with classic asset price models. Compare with the CAP-A, with the farmer-friendly 3-factor models, with the cohort 4, farmer-friendly 5, including here Professor Stambaugh's 4-factor model and other 3-factor model, etc., etc. And the Sharpe ratio here is about 3.5 different data lengths in the comparison. And their Sharpe ratio at the most is about 1.6, whatever. So it's much, much better. Okay? Really, all these models developed by famous people and used by a lot of people. Actually, you can say a lot of human work product alone. In a sense, in our view, AI really beats human. Because you're simply applying AI tool or machine learning tool, you get much, much better than the human beings who squeeze 5 years, 10 years to squeeze their head, thinking, come up with something with. And in machine learning, you get like in a fraction of half an hour, you beat them. So it seems that's the future. So AI seems like machine learning will beat the human being in many ways. Of course, a smart way in the future is a combination of AI with human being. Then you will surpass AI. Okay, but that's the next story. We will talk about this next time. Okay, but today we'll focus on AI. Not to combine AI with human being. Okay, just so far AI beats the superhuman being. Okay. Now think about accumulative wealth. Hypothetically, if one could invest in those strategies, even after all the transaction costs at the firm level, then if you invest in this like efficient portfolio produced by our method or by AI, then your wealth could potentially grow astronomically. If you do the market, you're doing still fine, not bad, but you compare with much worse. Okay. Now, if you use some other methods, actually, the second best method, actually, in our case, will underperform the market after the transaction costs. Okay, seems methodology-wise, our method is simple, but seems still survive transaction costs and doing much better. Okay. Now let's dive some deeper, ask some other very interesting questions. Okay, say we have so many factors. Which factors are important driver in the stock market, right? That's really one of the basic question. Look at just groups first. Right? If you look at the groups, look at intangibles are most important. And momentum, next group, the other group. Look at the top 10 factors. The number one factor, which is the earnings predictability for the earnings. If you can exploit earnings anomaly, your Sharpe ratio will increase about 15% otherwise. That's that 14%, about 15% is the Sharpe ratio of that contribution of that factor to the entire portfolio. So that's really in the real world potentially there's a lot of opportunity in earnings forecast, earnings prediction, earnings research. Okay. Then there's some other factors which are contribute one by one, but these are the top 10. Then by group, I mentioned earlier, here just give the numbers that the intangibles will contribute roughly 28% for the Sharpe ratio of the total portfolio. Momentum, about 12%. So momentum is very important. Like today, you got investors chasing for AI stocks, NVIDIA stocks goes through the roof. Okay, those are just huge momentum. Today, in the past too. So in the real world, really momentum is important. So and here we found indeed over all these years they have contributed roughly 10-12% to the Sharpe ratio. Okay, a lot of side question is that okay, how does our pricing kernel get improved if incorporate additional information from corporate world? Actually, we found is the other way around, is that information from corporate world, from the corporate bond in particular, it will not help equity. Equity will help corporate bonds, but bond will not help equity. Okay? To prove that, we show that the Sharpe ratio with all the factors you have, you achieve a Sharpe ratio of about, if you look at the bottom, about 2.8. This different time lengths. Okay. Then if you combine with the bond, you will do slightly even worse. The reason why is that first of all, the bond do not have much incremental information to you. Secondly, because you already have too many factors, but any additional more that potentially got estimation error will come up. As the estimation error increases, then the gain from investing in too many assets, whatever, will decrease. Okay, so in the real world, the estimate error is also very important. Okay, like information, you have some information is good. You have too much information that drives you crazy, then you have no good use of it, useless. Okay, that's kind of like that. Okay, so we're saying information. Once you have all the factor information in pricing equities, corporate bond information may not be that useful. A lot of things we examine in this paper, probably some of you may actually ask this question before this slide, that, okay, there's a problem of inclusion bias. In other words, here we talk about 174 factors. Okay, at the time, suppose like 20 years ago, how do you know 174 factors? You don't know. Maybe only a few factors that have been published you know of. If today, if you go back testing the results with 174 factors, that will be infeasible, will have introduced bias because we don't know at that time. So what one can do is that using our procedure the same way is that to do real-time implementation. At any given time, you use only those factors that have been published. People already know about it. Then if you invest the money, keep going move forward. Then in that case, actually we find amazingly that the Sharpe ratio will still be about 2.5 versus 3.5. Only drop about 30% not killing the results. Okay, it's still substantial, huge. Okay. Now, then we did this including bias analysis for all the other methods. When our methods, the loss of Sharpe ratio was comparable with different methods. Okay, so that's not the big deal. A lot of question is we do is that, okay, how about do this way? We have formed three-factor model, okay, which is the benchmark used by many people, okay? Let's say we go back to 1993 or 1980s, okay, that use their three-factor model, and it also use only those factor models published at the time, the top three-factor model. You just select by your AI procedure. Just keep a horse running. This is the best model, okay, studied, proposed by human being. This is at the same time, then you use AI to select a model based on information available at the time. Still use a three-factor model. Then you find that amazingly that your three-factor model will be Sharpe ratio will be from a fringe. In other words, if you do enough extensive data mining, okay, at that time, and with Farber Fringe published their paper, you could do a better three-factor model than what they did. Okay, because they didn't exhaust all the possibilities. Okay, they only pick up 3, which maybe they feel that's a reasonable, sensible claim as their three-factor model. But if for investment purposes, for better performance, you could potentially choose the one that drives your results in real time. Three-factor model do much better. Of course, that if you with all the real-time available factors to invest, not necessarily put the factor into 3. It could be 4, 5, any number as necessary. Just go in real time. Then your Sharpe ratio will be like suppose 2.47, much greater. That tells you that if you believe a three-factor model, or if you believe a flexible number of factors, the difference tell you how much that will cost you for your belief. So the moral of the story here, this slide tells you that one potentially want to be flexible in the number of factors in the real world. This year we do 5 factors, so 5. Next year 7. Following year 30. So what? Maybe at different time in the state of different economy states, the market may need more factors to reflect the economy. So number of factors should be different over time. The exact factor can rotate too. That's the point. This year we care about technology, AI. Next year we may care about healthcare stocks. The following year we may care about defense stocks. So the factors themselves, we really want to say one should be open-minded, numbers should be open, and the content should be open. Okay. So what's the takeaway? Takeaway is that we propose a simple methodology, which is well known in statistics, but which is very useful. One can use to apply estimate of the portfolio with big data. Okay. And we apply this to 174 anomalies. We find that on average, actually, there are about 50 factors that matter over time. Once you use this methodology, you'll do much better than otherwise. Okay, for example, the Sharpe ratio, you could get maybe 3.44, depending on the time length period you're looking at. If you take out the transaction costs, it's still 2.65. So our research seems to suggest that in the real world with big data, there's really potentially bigger profits if you use the big data, okay, in your quantitative way. Only be used by you guys quants. Okay, so this is where quants play a big role. Okay, big data, you handle them well, potentially generate bigger profits. If you use a smaller data, use a sparse asset price model, you have a huge cost. We say corporate bond matter to the stock market a little bit. Okay, and our conclusion is robust to inclusion buyers, whatever. And we did some other robust check I will go in through here. Basically, we feel pretty confident that the seems pretty much robust to almost everything we examine. So that's pretty much it. Thank you very much.
Well, good morning, and thank you to the conference organizers for asking me to participate here and get to discuss this very interesting paper. by Guofu and co-authors. I've enjoyed reading Guofu's work over the years a lot, and really great to get to see another paper that he's written, a very interesting paper. So I'll talk about the first question the paper asks in its title first: which factors matter for asset pricing? And talk a bit about the paper's results as I see them for that question. And then turn to, I think, what is another big question that the paper addresses, and that's how can the factor Zhou be used to obtain a high Sharpe ratio? Now, these first two questions do relate to each other to some degree, as I'll talk about, but I think that the paper has a lot to say, probably more about that second question. Then I'm going to turn to some sort of methodology questions I have about how they exploit this factor Zhou to get a high Sharpe ratio, and then just conclude with some final comments about the paper. And as Guofu explained, the factor Zhou they're going to deal with here is 174 different long-short equity portfolios. So each of these portfolios is based on some stock characteristic, and you go long one extreme value and short another, and you get a long-short portfolio. And there are 6 groups of these 174 factors. Intangibles is kind of a catch-all category. There are 52 of them in that category, but you see they're sort of scattered over the other categories as well. They also include the market factor as another factor, so that makes their 175 factor Zhou. And later in the paper, they also add 16 long-short corporate bond factors as well to look at the role of bond characteristics. So this first question, which factors matter? And the answer I take away from it is, well, many. So this REP strategy, their strategy that they develop here, on average chooses 52 factors, and that fluctuates between 34 and 79. Now, the market factor does get included 95% of the time, which I think is somewhat encouraging, I guess. We'd expect the market factor to show up in a factor model. And one way that they judge factor importance, as Guofu explained, is by this what I call exclusion metric. That is, you compute, first of all, the outer sample Sharpe ratio using all 175 factors. Then you exclude a factor and rerun the same strategy, and then just compare the outer sample Sharpe ratios and see how much the Sharpe ratio is reduced. And the factors that turn out to be most important, in the sense that when excluded, they reduce the outer sample Sharpe ratio the most, turn out to be this thing called earnings predictability. That actually accounts for like about half of the overall reduction you get if you exclude all the intangibles. The market factor, and then there's this other factor which is a year 6 to 10 return seasonality. And then there are 24 other factors that produce statistically significant reductions when you apply this same exclusion metric to them. So again, a lot of factors seem to matter. I was particularly intrigued by these two sort of non-market factors whose exclusions matter the most. I frankly have to confess I had never heard of either one of them. This thing called earnings predictability, it doesn't really have anything to do with sort of earnings surprises, which are a common sort of trading signal. Earnings predictability comes from a paper back in 2004 in the Accounting Review. It's the standard deviation of the forecast error in an AR1 model, first order autoregressive model, for annual earnings per share. So this sort of embeds both a persistence measure and an earnings volatility measure all in one. And I went back and looked at that paper, and I put a quote from it up here. And the bottom line is that this earnings predictability was one of the sort of least significant, where they found they had 7 different attributes of earnings that they found statistically reliable associations between with cost of equity capital that they estimated. Except this earnings predictability was sort of marginal, sort of one of the least consistent things. By far, the strongest thing they found associated was accrual quality, which is kind of a well-known anomaly. So I think they'd have been surprised to see this factor show up as very important. This other factor, I must confess, is this sort of embarrassing. I didn't know about this one either. It actually comes from a paper by Heston and Sadka, who discovered this rather interesting seasonality, that if you sort of bet on what did well in the same calendar month in earlier years, that sort of works, right? So for example, at the end of March, you look at the stocks that performed the best in the past Aprils, and go long those and short those that did the worst in the past Aprils. And it turns out that if you do that, looking back in months, or sorry, years, -6 to -10, 6 years ago to 10 years ago, that's this other factor that shows up as most important. So, I thought, this is interesting. I didn't know about these factors, and to find them show up as most important struck me as unexpected. I think some of this has to do with just this exclusion metric. How do I interpret the importance of a factor when I say, okay, I need the other 174 to be there, and if you exclude one, that hurts me. Well, I don't know. Does that mean that's the important factor? You could also think of an inclusion metric going the other way. And actually, the paper does have this other gauge of factor importance that applies this. Guofu mentioned this one as well, the so-called real-time three-factor model, where part of their procedure is to bound factor weights, bound the sum of absolute values of the factor weights. And as you loosen up that bound, take the bound essentially put lambda at like 0, and then start increasing it, loosen up the bound. Look at the first 3 factors that enter with non-zero weights, and think of those as the 3 most important. And you do this on a rolling basis, month through month, and think of that as a way to gauge factor importance, right? Which factors enter this algorithm first as you loosen up the constraint on factor weights. And here's a little picture from the paper that shows you, with time increasing across the x-axis, how these factors enter and leave that choice set. So that very upper bar is the market factor. So there are 28 of these that show up at some point in one of the 3 factors. But other than the market factor, you don't really see any really continuously long blue bars. You see some that are in there for spurts, things like, you got earnings surprise showing up early in the sample, but then never shows up again. You got book to market showing up for a while in the early part, but then rarely shows up again. Down below you can see sort of idiosyncratic volatility showing up and beta showing up, but never persistently. So again, my takeaway from this question, which factors matter, is, well, gee, most of them somehow matter, right? So many of them do. Which sort of is, as an academic, I guess, not a terribly satisfying answer to that question. As academics, we sort of like parsimony, right? Like simple stories, or we can sort of think of boiling things down and asking, what is most important, and an answer that says, well, 50 or 60 or whatever you need, it isn't as satisfying an answer to that question. But this other question, I think, that the paper addresses is, if all these things are important, how can you use them? How can you exploit them to obtain a high Sharpe ratio? And, I used to think, well, this is not really a good question for academics to be answering. This is like for money managers, right? So money managers want high Sharpe ratios. Why are we as academics trying to help them produce just high Sharpe ratios without really understanding, why they're coming from? I was thinking, well, occasionally these guys get very generous, right? So we, as evidenced by the recent gift that Bruce made to launch our master's program. So, maybe they don't need our help with this, but I think it is an interesting exercise for academics to engage in as well. That's right. How can we build high Sharpe ratios, even if it's a black box, right? So, let me just talk a bit about, and go through on some of this, but let me just to remind you all how the relation between asset pricing and high Sharpe ratios comes about. So I have a picture here where in the right-hand plot, you just have a plot of expected excess returns on the x-axis, the mu's, and the total volatility, sigmas on the sorry, that's the y-axis. The x-axis is the sigmas. So it's volatility versus expected excess return. All the little dots are just different assets. And as is well known, if you could form the maximum Sharpe ratio combination of all those assets, call it, say, portfolio P would be some portfolio has the maximum Sharpe ratio. Anything on that line from the origin out through P will do, because you're just levering it up and down by increasing or decreasing the cash allocation. That portfolio P prices assets. You can think of that as just a simple relation to the so-called pricing kernel, in the sense that if you compute assets betas with respect to that portfolio P, as in the left-hand plot, the expected excess returns all line up perfectly with those betas, right? So, so that's the link between sort of the maximizing the Sharpe ratio and pricing assets. If you think about exploiting the factor zoo, really what they're doing here is they're saying, well, we're not just going to take any old assets and try to optimize. We're going to make use of the work that a lot of folks have done already to try to find assets that seem to have high Sharpe ratios individually, and that is to combine these factors, treat the factor zoo as the asset universe in an optimization problem, okay? Now, the optimization problem, as Guofu also explained, has this sort of, in theory, simple solution, right? You just take the inverse of the covariance matrix of returns, multiply it by the vector of expected excess returns, and that vector is proportional to the weights in the portfolio that would maximize your Sharpe ratio. The neat result that he talked about, that goes back to Dave Jobson and Bob Corky's work and Mark Britton-Jones later on, is that you can recover these weights by running a regression, just a regressive vector of ones on the matrix of asset returns, and you get this coefficient B hat. That's an estimate of those weights, proportional to those weights, but it doesn't work very well when n is large and you have a finite sample. So the solution that the authors propose here is a so-called LASSO, where you basically run that regression but with some constraints on the results. And they also pin down sort of where on that Sharpe ratio, maximum Sharpe ratio line you want to be, what portfolio P do you want to have, by having a risk aversion parameter. And in fact, you can show that for a given risk aversion, the optimal weights, omega star, are just 1 over risk aversion times the true coefficients in that regression. If you could run that regression with infinitely many observations and call that coefficient vector B, the optimal weight would be 1 over gamma times that. And that's the same as just regressing then 1 over gamma times the vector of ones on R. What they do here is sort of follow up on an earlier paper that does this, the so-called constrained or LASSO regression, where you run that regression, you minimize the sum of squared deviations from the regression, but subject to a constraint on the coefficients being less than lambda. So what this does is this LASSO actually stands for least absolute shrinkage and selection operator. So it both selects some assets to have different weights different from 0, and then it shrinks those weights towards 0 as well. What I've wondered about in this vein of work, though, is sort of this issue of selection versus shrinkage. Is select a subset a desirable part of the answer to how can use the factors due to obtain a high Sharpe ratio? After all, if I can go back to the solution here earlier on, that omega star, in theory, doesn't have any 0 elements in it. I mean, basically, that's a full vector in theory, right? So my question is, do we really want to do this selection, or could we do something more like just shrinkage without the selection? And that gives you the difference between LASSO and ridge regression, right? Where LASSO is a so-called L1 norm, Lebesgue, or L meaning Lebesgue, a mathematician. And the L2 norm would deal with squared deviation, squared weights, which would basically, again, move the weights towards 0, but not force some to be 0, essentially. I think shrinkage is a clearly desirable thing to do. We don't want weights coming off here as extreme. That's what destroys your out-of-sample performance. You can actually compromise between these two. In fact, some of Guofu's well aware of this. In some of his early work, he has a so-called elastic net where you can combine an L1 and L2 norm. just to review briefly what these things do, if you think of an L1 norm, you constrain the sum of absolute values. You can think of that shaded region there as being the constraint set, and asking where would a value contour hit if you're trying to maximize a function whose actual maximum is the red dot, or in this case, minimize a function where the actual minimum is the red dot. A contour is likely to hit at a corner there. In other words, where one of the two assets is got a zero weight. Whereas if you impose the L2 norm, where the restricted region of the weights lies in that shaded circle, you're more likely to get that circle bumping up against a contour where both the weights are non-zero. And it again shrinks the weights towards zero, but doesn't impose a selection criterion as well. Just a few additional methodology questions quickly. Should we penalize turnover? This rep strategy turns over nearly 6,600% a year. So they have a 60 basis point trading cost, which drops the average return from about 77 to 39%, and the Sharpe ratio from 3.59 down to 1.65. But should we also impose a turnover penalty in the actual procedure, right? Rather than just let the procedure run wild and then ask what it would do if you deduct transactions costs, right? Should we penalize positive and negative weights symmetrically? Because shorts are generally costlier to implement than longs. Should gross exposure leverage be constrained? So this rep strategy has average gross exposure nearly 800%, like 400-something% long, 377% short. My understanding is most long-short equity managers have gross exposure more in the neighborhood of 200%, 300%. I mean, how many out there have 800% leverage at running long-short equity portfolios? Probably not, right? So should we also constrain leverage, right? Could that, if you're actually thinking about implementable strategies? Should we treat the market factor the same as the other 174, right? If you think about the other 174, they're stocks versus stocks. The market factor is stocks versus cash, right? And you might think they have good reason to believe stocks are going to outperform cash a priori, as opposed to a stock versus stock comparison. And then finally, the nice asymptotic results they have here, where you take a ratio of log n over t, log n being number of factors, t being number of time series observations going to 0. I'm sort of wondering how that really addresses the factor Zhou issue. As Guofu explained, in short time, we've had this factor Zhou sort of explode in number. I think some asymptotics that would really just hold t fixed and figure out what happens if I can increase n. Okay, we get desirable methods that would work well if we just have increasing n fixed t asymptotics would be a nice way to come at it, I think. But in closing, let me just say that I thought this was a very interesting paper. First of all, showing how difficult it is to answer the question, which factors matter. That, with the answer being, it's not so clear how you come up with a simple conclusion from that. But also providing a very intriguing use of the factor Zhou, which refines and extends this regularized regression approach. It's very nice empirical results. I mean, it wins the paper's Sharpe ratio tournament, handily. So I think that's a very compelling aspect of the paper. And I do think there is potential for further extensions, right? This is a fairly compact optimization problem. You're optimizing over 174 weights as opposed to hundreds of thousands of parameters in a neural network or something, where it's hard to optimize with very realistic constraints. So I do think it's a nice, in some sense, parsimonious way to use lots of factors, and I do encourage some further extensions there. And I thought finally the bond factor results were interesting. That there's this novel result that once you include all these equity factors, unlike what other some studies have found, where they use a reduced set of equity factors, that when you include lots of equity factors, you don't really need bond factors at all to help price equities. But equities help price bond factors, which confirms earlier evidence. So again, thanks for letting me discuss the paper. Found it very interesting.
Guofu, you want to respond to Rob and join him on stage, after which we'll open it up for audience questions and comments.
Yeah, first I want to really thank you, Robert, really for your wonderful, generous comments, for your deep insights in various sorts of problems. Let me just for a couple of particular issues that without LASSO, you can do ridge or E-layer. The reason we didn't do ridge or E-layer because we haven't figured out the analytical proof yet. Numerically, we tried. Numerically, they perform slightly worse, which we're still trying to understand why you do investing in all of them, based like read flat out, somehow results not even slightly worse. And anyway, the key we didn't include is really the theoretical issue. We haven't figured the theory that how to prove the convergence. Is that the case? So on the
Okay, I won't accuse you of method mining.
yeah. And other questions that I think next stage, indeed, we can impose various restrictions, like only like 130/30, also impose the leverage restriction overall. Actually, in a different paper working on is that with different co-authors that we very interestingly, amazingly, we found that you can impose low short sell even. In that case, low short sell will not actually suffer too much. Of course, here all the factors themselves involve short sell, but there you want to say no short sell, they want to impose no extreme short position. But that can be done. The result will be affect to a certain degree, but will not affect too much. Probably like 20% also. So all the other questions are doable. I think is really also put us thinking further and refining the paper. Really appreciate your deep insight and really all very helpful comments.
Sure, an interesting paper. Enjoyed it.
Yeah.
Okay, thanks, guys. So if you have a question, yeah, please raise your hand. We have mic runners, so keep your hand raised until you receive a mic. We're in a big room, so we're going to need to use the mics to hear your question.
Thank you. Interesting paper. I have two questions. First one is about the stability of your pricing kernel. So with your 174 factors, we all know they're highly correlated. So with LASSO, typically they will just randomly select one out of the highly correlated variables. So I'm curious, over time, do you observe instability in the selected variables? I guess in the discussion, the real-time three-factor charge is perhaps a way indication that sometimes some factors coming in and going out of the selection fairly briefly. That would also have an effect on high portfolio turnover. So that's the first question about the stability of the pricing kernel. Second question is mainly a clarification. I'm curious why in your selection, the factor rule, there are no industry factors unless the characteristics are industry neutralized already. Thank you.
Yeah, first, I will thank you for your two questions. And your first question is that for the stability, that true for LASSO, if there are some factors which are highly correlated, in that case, LASSO might pick up their best combination, whatever. Okay, there's some slight intermittency there, but among this 174, you can see the clusters. So there are only small clusters with highly correlated. Broadly speaking, the correlation are relatively low. That's why in that sense, that's why the results are better, are much improved. Now, also why the results are better, even that ridge, if really highly correlated, all of them are highly correlated, ridge will help you to do better. But we found that actually ridge underperformed somewhat. Okay. Now, as to I agree, the turnover will be high. because some factors will be coming in, will be coming out. That's really, the surgery, you estimate in real time using rolling data. That so it's unavoidable that the factors will come in, come out. Whichever time period, some factors are more important, that factor will come in, that will come out. That will result in high penalty for your transaction costs. That's for sure. But we adjust for those transaction costs, which is still a substantial higher Sharpe ratio. We're still hopeful today that with the diminishing trading costs, hopefully that it become more variable. So that will be really on your stability issue. So by design, so the factor rotation is a mechanism there. So you will be there. Okay, maybe you can enforce some stability. Like Robert says earlier, is that actually in our model that we could control transaction costs by designing minimizing turnover. You could put turnover as the objective. Combined object is LASSO to penalize high move over, turnover. Because then you're imposing a quadratic restriction. Yes, think about proportional turnover transaction costs. Then there will be additional quadratic constraints. And with that one, it will be solvable. The problem will be doable. We haven't done that yet. Maybe that's really something we will try next time. Yeah, to impose a restriction on turnover. Then when we have turnover, will be more smooth, more gradual. So that will address your first problem. The second issue is that, actually, I forgot the second one. Sorry, I was thinking about the first one. This I forgot the second one. Could you remind me the same question again?
Industries.
Yeah. Oh, industry finance. Yeah. Okay. Yeah, Robert has an excellent memory. Despite he's older than me. Of course, I won't reveal how old he is. Okay, but he's older than me. Yeah, because he has more experience than me too. Okay. For the industry one, that's one we didn't incorporate. We only incorporated for simplicity all the variable factors. People talking about anomaly factors, but Like if you are interested in investing in particular industry, or you care about industry characteristics, in per se, certainly you can augment or expand our study to do that. To see what's the impact on that one. That'll be your paper. That'll be your practitioner impact. You make money with that information. That's your innovation. Right? So that's certainly open the door. Not saying that our method is not applicable to that case. It is applicable. Just we have not tried it that yet because there was no motivation from our side and the present. So if your investing strategy with your constraints on industry exposure, you can certainly add them into the optimization framework. That I think that certainly will try to mitigate both objectives, making the best combination. Yeah.
Thank you, Professor. Really enjoyed the presentation. My question is regarding the underlying macro environment. Say if you're using past data, and I understand the result as well, but if we want to use the result for the future, and if we essentially come from a transition from a high interest rate environment to a lower interest rate environment, can you help us think through on how we can utilize some of these results?
Oh, okay, that's a great question. Okay, if I know the future article, probably I wouldn't be here. Okay, where? The one thing though, philosophically, it's true. Not seriously, that I agree with Reed Daniels' view. Is that I think he said something like prediction is important, but it's very difficult, incredibly difficult. The transition, we don't know when it will occur, how long it will take it to occur. So the key actually in this case is that to identify the time it occurred. So that's the beauty of this quant. We don't predict, you don't have to predict it. It's just use your algorithm to track it. When the regime comes, automatically into it. So this is exactly the rolling estimation coming into play. We don't rely on any prediction in our procedure. We just keep tracking the progress, performance each factor, performance of whatever. Then when the bad economy comes, those evidence already come here. You incorporate them gradually. So you're not a predictor. You're using the outcome of prediction. If somebody is able to predict, you're able to use it. That's really the key. because predicting by yourself is very, very incredibly difficult for everyone, for every top hedge fund manager I know of, I heard of, because the key again is to be able to identify the regime when it comes. You got to keep tracking, keep going, update learning, basic learning, update your learning. So when it comes, you are there. So then don't worry about it. Recession comes 3 years from now. We got bull market in US running for 20 years. We're a lot of people worry about next bear market. Actually, our philosophers, they don't worry about it. Just keep riding on. When it comes, so what? Then you make a lot more money when you're on the rate you're riding. Rather than worry too much, then you're on performance too much. Anyway, that's our evidence, our philosophy.
Hi, thanks. William Siegel, NYU. Great presentation. My question is, have you looked at the robustness of your results with respect to missing data imputation? Is there a lot of missing data? Thank you.
Yeah, that's a great question. Or change too. In the real world, you deal with the missing data, outliers. That's definitely the huge science branch of science itself. In this paper, we haven't dealt with that. We are taking those factors people have created for granted. What we are saying is that potentially we can create more factor space, enlarge the factor space by imputing data, by putting more factors which we throw away, because only factor in our study which has missing data, we just throw them away. Yeah, we just took a simple hands-off approach. I think it's certainly that you certainly can do even better by incorporating additional data, especially if you're concerned about international investments. In US, we have big data, beautiful, everything available. You do international, I think data imputation play a very important role. That how do you learn from US data about the missing data in a foreign country? What will be the implied performance? Then from there, how to build up an international model so that potentially have a longer history and have better performance look forward to the future. We all care about future performance. I absolutely agree with the former Chris answer. But the issue is that if we're able to look back farther than other people, probably you can perform better in the future too. Yeah, because they have better judgment of what is likely to come. Yeah, certainly the data mining approach, data imputing approach, I think will be very useful for the next extension of the paper. We haven't done it yet, but I think it's very, very, very interesting direction. Yeah.
Okay. All right. Please join me in thanking Guofu and Rob. Thanks, guys.
Thank you.
Great presentation.